Hi everyone, today I'll be sticking with the recent dividend theme of the channel. Due to popular demand, I'll be recommending 3 US dividend growth stocks. I usually focus on Canadian stocks and dividends. However, I've been missing out on a huge market and potential huge returns. The US stocks have been booming while Canada has been stagnating a little. Also, the US dollar has been increasing, so if you've had US investments, you're getting both the capital appreciation and you're getting the foreign exchange gains. Please thumbs up the video and subscribe to the channel where I give advice on stock recommendations, tax advice, Canadian finance, and once a month I do live trading of stock options if you're interested. If you'd like to sign up for a free ebook, I have a pinned comment and a link for beginner Canadian finance advice if you're interested. Stick around to the end of the video where I tell you where to invest in these stocks, so which account and how to do it. First recommendation is Johnson & Johnson, ticker JNJ, currently trading at $150 US and paying a yield of 3.32%. This is an annual yield, but they pay you quarterly. J&J is one of the most valuable companies in the world and one of the best stocks you can buy. It's only one of 2 US companies with a AAA credit rating. The only other company is Microsoft, and not even the US government has a AAA credit rating, which I think is hilarious. Looking at the last 5 years, the stock appreciation hasn't been great, but I think it's because it was overly inflated from the bubble and the free money they were getting during the pandemic. It's 17% off its all-time high, but I think we can quickly get back there. They've been paying dividends for 108 years without ever decreasing, but also they've been increasing for the past 61 years. The average increase is 5.3%, which more than beats inflation. The free cash flow average over the last 10 years is around 50%, meaning out of their normal operations, they've been paying out 50% of the cash received in dividends, leaving another 50% to reinvest into the company or to grow the dividend. I'm not going to get into the ethics of investing in this. They appear to be focusing on profits rather than patience, and the lawsuits don't seem to hurt them. They've been paying billions in lawsuits, but the stock keeps going up. I would try to reinvest the dividends on this and hold for the long term. Second on the list is Pepsi, ticker symbol PEP, and currently trading at 157 US per share. I keep trying to tell people US because there's like a 40% difference between the CAD and the USD right now. The yield is 3.43%. They've had impressive growth over the last 5 years while maintaining a healthy dividend. They've increased 15% in stock price, but also they've been increasing their dividends 3% per year, so just about keeping up with inflation. But let's focus on the long term and the dividend reinvestment potential with the stock. They've been increasing dividends for 53 years, and they don't seem to be affected by any recessions or slumps. So I'm just guessing, but I think their products are cheap enough that people will still want like small joys or cheap-ish snacks during the good times and bad. I'm not saying the stock won't decrease during a recession, but I don't think the revenue would get hit too hard, and a stock dip would give me more of a reason to buy this stock. If you already have Coke as an individual stock in your portfolio, I probably wouldn't buy Pepsi since it would be just like double of almost the same thing. If maybe you have Coke as like 1% of your portfolio and you have room to allocate more to this industry, then I'd be okay by doubling it and buying Pepsi as well. Last on the list, making its debut on the channel, I've never recommended this before, is UPS. With e-commerce booming, UPS is cashing in big. Every time you click buy now on Amazon, there's a good chance that UPS is getting a cut. Their focus on efficiency and automation gives them a competitive edge. Plus, they pay a healthy dividend with room to grow as the profits soar. Currently trading at 125 US per share, they're only up 6% over the last 5 years, but they're paying the highest dividend on this list that I've made. They're paying quarterly dividends with an annual yield of 5.19%. The stock increase isn't that impressive. However, if you look at the dividend growth over the last 5 years, which is 11.4%, then over the last 10 years, it's been increasing payouts by 9.5% on average. This is a clear contender for a long-term hold. Use the dividends to reinvest into the stock and take advantage of those huge dividend increases. You'd be getting a 10% raise on average every year for the last 10 years. For Canadians, it's important to focus on which account you'd be buying these stocks in. Every dividend payment from a US company is subject to a 15% withholding tax, which hurts. And then you're also not getting any beneficial dividend tax credits like some Canadian companies do. My recommendation, only invest in these stocks using a registered account like an RSP. Canada has a tax treaty with the US where the RSP is exempt from the 15% withholding tax, giving you free rein to reinvest and snowball the dividends without worrying about any cross-border tax issues. I don't recommend to use a TFSA. I would save the TFSA for growth stocks or even Canadian stocks. Even though the tax-free savings account says it's tax-free, the US doesn't recognize it as a registered account, so you'd be hit with a 15% withholding tax if you have a US stock paying you dividends in a TFSA. Make sure to realign your portfolio if you have this problem in your TFSA. It's eliminating the benefit of the account if you get taxed. There's no point in the TFSA if the T is not there. If the TF, tax-free. Lastly, if you've maxed out your RSP already and you're forced to use a taxable account, I would try to switch the stocks by using sell the Canadian stocks in the RSP and invest in them in your taxable account, just so you can get the 15% back, as well as sheltering any FX gains. But again, everyone's situation is different. I'd have to look at your exact portfolio and when you want to retire or pull out the cash to make a better recommendation. Thanks for watching. This is a short video. Next week, if I have time, I'm going to focus on US dividend ETFs instead of US dividend stocks, like in this video. Even though I probably have 100 more stocks I could recommend, I'm going to keep the dividend theme going. So I'll probably focus on this for the next few weeks. And if you guys keep watching, maybe the next few months, let me know if you have any questions. Thanks for watching and tune into the next one.